Hey, good morning, everyone. Marty Missouri here, Friday, June 10th, 2022, with your weekly economic update. And once again, a stock market snapshot at the end. So today, I actually want to kind of breeze through the economic update to get to the stock market commentary. On these snapshots, we look at the technical setup for the market. So I want to do that, but I also want to talk about this options exposure that I've been writing about this week. And most importantly, in the process, help you clients in particular keep your heads about you and have a real healthy, accurate perspective on what's going on under the surface right now. Let's get through the macro update first. Our index actually dropped just 2 points this week to 14.04. Still, I don't know if I'd say comfortably, but still a notable gap between here and what we would deem recessionary conditions or high odds of near-term recession. In terms of the handful of inputs, there's 46 altogether, but each week I just show you some, often the high frequency ones that update weekly, and ones that I think are pertinent relative to today's setup. Mortgage apps continue to fall, which should be of no surprise to anybody with this inflation, higher housing prices, higher mortgage rates, and so forth. So 208.2, I've mentioned here recently, builder confidence is definitely waning. We could get into the weeds in terms of the underlying character or structure of the residential real estate market. A lot of people are very bearish. Some people remain bullish. What it's not, folks, is it's not the setup that we had coming into the big 2008 disaster. I can tell you that from many, if not all, of the underlying factors that you take into account when you look at the residential real estate market, factors other than simply higher interest rates, right, and rising prices. But when you look at average FICO scores, the balance sheet health of the consumer, lack of building over these many years, meaning lack of available homes for sale. Of course, the disaster here was residential real estate. The natural extended response to that would be much less of this, right? So that we enter into this slowdown in the real estate market in a less frothy position than we did going into here. I'm certainly not suggesting that home values aren't about to come down. I'm just saying we don't have the setup that we had back here, leading into the 2008 recession. Initial jobless claims actually took a notable tick up. They went from 200,000 to 229,000. Again, still, as I keep saying, historically low. However, you don't want to see an upward trend there, right? See how nascent upward trends tend to lead right into recessions. That one was a little longer, and so forth. So definitely something to keep an eye on there. In terms of continuing claims, that actually continues to go down. That was a tick lower, which is just amazingly low historically. And remember, these numbers are not adjusted for population growth. Heavy truck sales was actually a positive, just a slight tick upward, kind of arresting the short downward trend that we've had right here. Global PMI, Purchasing Managers Indices, JP Morgan does an aggregate of the world, and that actually ticked up 0.5 point, so that is a net positive. Below 50 denotes recessionary sentiment or recessionary conditions, and so a move higher there is welcome. So the inflation data came out this morning, and that just exacerbated a downward move that began yesterday, late in the session. And it was the CPI numbers. So headline CPI, which includes food and energy, actually went up to 8.6%. Month over month, 1%, right? Which would be 12% annually. So that's a pretty scary number right there. When you take out the volatile food and energy, which is, whether or not I agree with that doesn't really matter, but because we spend so much on food and energy, but that is how the powers that be look at this because those two are so volatile. Core CPI, that actually went down a titch on a year-over-year basis, and looks like it was pretty flat, up just a little bit on a month-on-month basis. So 6% when you X out food and energy, 0.6% monthly, month over month. So folks, I do think we're very near peak inflation. I am a structural bull on inflation, meaning that I think inflation is going to be notably higher in the years to come than anything any of us have experienced over the last 40 years. with the caveat that along the way, as we have economic slowdowns and recessions, of course, then those are disinflationary events typically. You could have commodity inflation pushing against that even during that, things like energy prices a la 2008. But nevertheless, recessions are disinflationary phenomena. And we're not in the recession camp like a lot of people are. So certainly the market reacted to this morning. I suspect, in the months to come, we'll get the market reacting to tamer prints as these things begin to unwind. But of course, so much of it depends on the Fed's perspective on all of this and what they say and do in the weeks and months to come. I mentioned copper last week, and I suggested that maybe poised for a bit of a rebound. A lot of it based on what I expect to be positive news out of China. We've gotten some of that. Some of it's been mixed, a little back and forth there. But yeah, copper has ramped up nicely. Since I reported this to you on it last week, I did say that we were developing a bear flag that, of course, could play out in the near term and give us lower numbers, which would have no impact whatsoever on our long-term bullishness around copper. Right now, though, that bear flag didn't play out. This is too much of a flag here to call it a flag, if you will. So yes, the move in copper, of course, that's an inflationary scenario, but it's also positive in terms of global dynamics. The Baltic Dry Index, which is the cost of shipping dry bulk goods across the world's oceans, that's come off a little bit. So that would be, let's call it a disinflationary force for the moment. Now, if China really opens up and ramps up all the infrastructure spending that they're threatening, well, then that could move that needle back in the other direction. So we'll keep an eye on that as well. And then last but not least, this was a positive indicator for us last week, and it lost 1 point, went from positive back down to neutral. And this is the ratio of certain sectors to the S&P 500. Anything under 100 means it's underperformed the S&P 500. You can see tech is, you can see now that financials are, and you can see that consumer discretionaries are. All the while materials are still nicely outperforming the S&P 500. Energy hugely outperforming the S&P 500, and then industrials are pretty much just barely, 99.9, 99.95. So those are close. Consumer staples notably underperforming the S&P 500, and of course that speaks to the latest news from Walmart and Target, which are big positions in there, talking about how they overdid it on inventory. I wrote about that a little bit and referenced the latest news on Target. Utilities, a defensive sector, outperforming. Healthcare, a defensive sector, slightly outperforming. So folks, that's the economic wrap up for the week. Again, we're not in that recession camp as more and more people are migrating to. Very open to that idea. That's just not the assessment that we come up with at the moment. Okay, this is what I wanted to get to. Okay, so as I speak, the S&P 500 is down a whopping 2.8%. NASDAQ is down 3.5. That's a big down day. No ifs, ands, or buts about it. Those of you who don't have any constraints on your portfolio, like tax issues, embedded capital gains, and so forth, just so you know, the core portfolio this morning is capturing less than a third of the decline. Okay, so we have stuff in there that's working. Gold is up nicely. That's a big position for us. Silver's up nicely. And everything else is down, save for the put hedges on the S&P. They're, of course, having quite the day. And we added a hedge on our oil exposure, and we have an existing hedge on our ag commodities exposure. So, we have half a dozen positions, but notably the options, the put options on the S&P. And gold and silver are helping out today as well. Now, any of you who might be, getting a little sideways over this, if you've been watching the videos, right, this should not be the least bit surprising or bothersome or what have you, because we've had a target down here on the S&P 500 presently, based on all the information we have at our disposal, that's still 10% lower than where it is trading this morning. And this is a big candle right here for this week. This is the weekly chart. So there's a lot left to play out to the downside, and this bear flag is looking like a perfect pattern right here so far, which would take us right down to that spot, essentially. Now, I have shown on the shorter term charts, and I'll show you in a minute, that some evidence that called this one pretty much right on the nose, and I do think we could really see some exaggerated upside. And I'll talk about that as I get to the shorter term charts. So on the 1-year daily chart, let's first look at the patterns that we had here. So we had this downward wedge, or this falling wedge pattern. With bullish divergences, we broke out of that, and we're coming right back down here now, and looking to, at a minimum, test this downtrend. And if we continue, just precipitously, we're going to butt right up against that key, and it was a key Fibonacci retracement level of around 3,800, 3,815, which is right where we were expecting the market to form a short-term bottom last time. I've said all along, I think this will get tested, and I think we'll see another bounce again right off of that. I think some people may think that this is the ultimate bottom. Of course, we think it's a bit lower than that. So you've had these last couple of days, you've had this big red candle yesterday, gap down today. Now, gaps tend to be filled. This one will, I would say, with a great deal of certainty. Whether it's very soon or further into the future, we will see. But one thing I want to point out, in the last couple of days, again, I've been sharing with you, some of the complexities around all of this options action that's going on in the market, right? I mentioned today that our puts are way up, right? So there's a counterparty to that, the people who sell these puts. We'll just refer to them as dealers for the sake of this conversation. So we, via one of our resources, understand that there is a tremendous amount of put exposure right around this 4,100 mark here on the S&P and below. Now, I explained yesterday or Wednesday and again today that the sellers of this put exposure need to hedge their exposure or they can get creamed. It's called gamma hedging as the market moves against their positions. And what they have to do is they short stocks, which is essentially borrowing them and then selling them into a market that's already declining, and boy, can that exacerbate it. So this source of ours said that this is some very serious concentration of puts in here, and if we break below that, we could get a quick move down to 4,000, and we got that yesterday. And there's a lot of exposure right here as well. So if we break that, the term they use is we could see the market pin to around 3,900. Now they do think that there will be some strong reversion because of all this gamma exposure right here, kind of draw that back to the 4,000. Not seeing that right now. In fact, the S&P is down there real close to 3,900 as I speak at you right here. So folks, here's my point. Yesterday, there really wasn't any news. There was just some selling that kind of broke the ice right there, and kaboom, it fell. So what we want to do is avoid interpreting some of this action as something that's fundamentally changed in the world. Well, of course, we know inflation is crazy high right now. We know it when we go out and go shopping, and we know that the market has discounted a lot of that already. The rest of it is this positioning stuff that I keep talking about. Now, as I said in the morning note, with regard to this, shorted stocks are stocks that are borrowed and sold, but stocks or shares that need to be given back to the lender. So all of that action, to the extent that that's in there, will have to be covered, meaning it'll have to be bought back. And depending on the market environment, if there's not a tremendous mood to continue to sell aggressively as these people buy, well, that can spark or certainly exacerbate something to the upside. And before you know it, we're back here talking about our 4,300 level again. Next week, we have the Fed meeting. Next Friday, we have supposedly the biggest options expiration on record. These puts, by and large, I suspect a huge number of them, if not the majority, are expiring next week. Now, if this action continues into next week, once they expire, well, then these shorter positions will be covered because those hedges will no longer be needed as everybody kind of reboots and so forth. So here's my whole point the last couple of days. I really want you to understand that in this kind of environment, off of these levels, when we know there's a lot of short interest out there, we get these huge short covering rallies. So just as I'm saying here, this is something to understand is, very not fundamental, at least the dynamic that I'm explaining right here. An unwinding of this, if that leads to a big whopping rally, I'll be telling you the same story. is that do not get excited. With regard to the downturn, yeah, could it ultimately break that very thin ice that I've been talking about for the last 2 years? Certainly it could. And we could get something more meaningful to the downside. We think there's something more meaningful anyway when I look at our 3,500 target, but it could get worse than that. That's why we hedge when the ice is this thin. We're definitely going to take some drawdowns. There's no ifs, ands, or buts about it. But like we did back in the big decline, around COVID in the spring of 2020, we are working very hard to duplicate that sort of experience, meaning mitigating the lion's share of that downturn. So folks, I've probably beaten that horse to death the last couple of days now, and that would be my effort to help you understand the underlying force that is all of this options action and how it can really influence the directional move in a really big way. I will leave it there. Thank you, folks, as always, for watching and listening. We really appreciate you. Have a great weekend. Take care. Bye-bye.